Up, everybody? Welcome back to Trades and Gains. I'm your host, Max Pitts, and wow, what a week for earnings so far. We had crypto companies reporting, Swiss sneaker brands showing off, AI cloud players losing money faster than you can say, GPU shortage, quantum computing stocks reminding us that physics is still hard, and a salad chain that's somehow worth more than half the restaurant industry. In other words, it's like speed dating on Wall Street. You sit down, they tell you how amazing they are, you check the bill, and realize that they're broke. So let's start with Circle Internet Group, because nothing says public company debut like losing halfly near $1 billion in your first earnings call. Circle's the company behind USDC, the stablecoin, which is basically a cryptocurrency that's supposed to not move in price. Like your paycheck before inflation. Revenue jumped 53% to 658 million. USDC circulation up 90% to 61 billion. That's right, their stablecoin is more popular than Ozempic at a Beverly Hills brunch. But here's the kicker. They lost 482 million. Why? 424 million in stock-based compensation and 167 million from debt reevaluation. That's what happens when you go public. Wall Street says welcome and then sends you a bill for a new yacht for your executives. They also announced ARC, a proprietary blockchain launching tests this fall, because every crypto company needs a side hustle in case the main hustle gets regulated. And since their June IPO, the stock is up 450%, partly thanks to the Genius Act loosening US crypto rules, which, by the way, stands for generating every net job investor unnecessary speculation. And speaking of speculation, let's talk about a company that sells sneakers for people who don't actually run. On Holding, the Swiss sneaker maker, had a blowout quarter, 32% sales growth, gross margins over 61%, and direct-to-consumer sales up 47%. Asia Pacific, the sales doubled there, and yet they lost 11 cents a share. How do you beat revenue estimates by nearly 60 million and still lose money? It's like winning the marathon but dying at the finish line. Now, these are premium running shoes, $150 to $200 a pair, and their apparel sales jumped 67%, proving they've cracked the code, selling performance gear to people whose idea of cardio is walking to the fridge. The stock's down 16% year to date, but they raised guidance for the year, which means investors are basically saying, we like the shoes, we're just not sure we trust the guy selling them. But at least On has shoes. Our next company sells the digital equivalent of oxygen and still can't make a profit. CoreWeave, the NVIDIA-backed GPU cloud specialist, crushed it on revenue, 1.21 billion, beating estimates, and yet the stock fell 10%. Why? Operating expenses quadrupled to 1.19 billion. That's the kind of spending that makes Congress look thrifty. They've got a major supply deal with OpenAI, and they just bought weights and biases to beef up their AI tooling. The problem, they can't spin up data centers fast enough to meet demand. Imagine having a gold mine, but the only tool you own is a spoon. And oh yeah, 8 billion in debt plus the IPO lockup ends this week, which means insiders will be able to sell for the first time. And I'm guessing they're already practicing their yacht shopping face. Still, CoreWeave's in the hottest space in tech. If they fix capacity and margins, they're golden. Until then, it's like watching a Formula One car with gas leak. Fast, exciting, and maybe about to explode. Now, from AI to quantum computing, because apparently this week's theme is cool science that loses money. Rigetti's revenue dropped 41% to 1.8 million. Losses widened to 13 cents a share, but they did unveil the largest multi-chip quantum computer in the industry, which sounds impressive until you realize you can't eat it, you can't wear it, and currently it makes less money than a lemonade stand. They've got a $35 million investment from Quanta Computer, and analysts still love the stock because, let's be honest, quantum computing is like cold fusion. It's always 5 years away, but if it works, you look like a genius for buying early. Until then, they're basically the Tesla of subatomic physics. All hype, negative cash flow, and a really cool PowerPoint. And finally, let's end with something we can all relate to: overpriced salads. CAVA's revenue grew 20% to 278 million. They beat earnings estimates at 16 cents a share, have zero debt, and 386 million in cash. Margins 26%. This is a restaurant chain. Those are luxury numbers. The problem, same-store sales were up just 2.1% versus the expected 6%. Why? Because last year they launched steak, which caused a huge spike. This year, no steak, which means no sizzle. Still, they opened 16 new restaurants and are testing AI kitchen tech to improve efficiency, because nothing says farm to table like your euro being assembled by Skynet. So, what did we learn? Circle's printing stablecoins and losses. On is running but tripping. CoreWeave's an AI giant with the spending habits of a drunk sailor. Rigetti's proving quantum computers can solve everything except profitability. And CAVA is the rare restaurant chain where the debt is zero, but the hype is high. Wall Street's a lot like dating in your 40s. Everyone looks great in their profile, everyone has a plan, and the baggage shows up the minute you commit. Thanks for showing up to this today. This is another earnings recap. I hope you all have a great day. See you guys in the next one. Make sure you like, subscribe, comment. What's your favorite earnings so far this week? Did you make any bangers? I know our group took CAVA, and we're going to wake up to some nice gains in the morning. Hope you all have a great day. See you in the next one.